Okay, everybody, welcome back from the breakout session. This is going to be probably the most exciting for me. For those of you that know me, know that I am really into market analysis. Really, market analysis does not excite a lot of people. For whatever reason, it excites the crap out of me. Which, call me weird, call me stupid, I don't care. I love digging into the numbers. I was doing a market the other day. Which one was I doing? Portland yesterday. I was doing the Portland market, and not very many people care about Portland, Oregon. There are a couple of people on here that are from that area, but not a lot of people care about investing in Portland, Oregon. It is a rent-controlled market, at least the city of Portland is. So it was interesting diving into the numbers as I was doing the video, that the numbers were telling a story, and that we could look at those numbers and we can see the story that the numbers were telling us. And what we gleaned from that market was it was the strongest Class A market we've seen in the country, which shocked the bejesus out of me. I did not expect that. But it's interesting to see how the numbers can tell a story. So when we do this lesson, off market intensive session number 2, identifying your market, we are going to look at the Orlando market. I have not done the Orlando market yet, so this is kind of a sneak peek. I think I'm still three or 4 weeks away from doing that video, but we're gonna have a little fun looking at the Orlando market. So any questions on anything we've covered up to this point, or are you guys just excited to dive into what's going to be probably the most exciting part of today for me?
Exciting.
Let's get into the number geeking.
Very interesting. We shall get into then. All right, if everybody will mute themselves, I'm going to close that. Can everybody see my screen?
Yes.
Okay. Yes. So you can hear me. You can see my screen. We are ready to move. So I'm minimizing this so I can no longer see your beautiful faces. All I see is my presentation. I do still have my chat up if you have questions along the way. And of course, you can stop me as well. All right. So session 2, what are we going to cover in this session? Well, first, I get the question asked all the time, should I invest in my local market? So we'll look briefly at local versus remote and give the benefits and the downfalls of both. Then we'll look at market cycle fundamentals. I think knowing how to plot your market or the market you're investing in on the market cycle chart is probably one of the most valuable tools you can have in your toolbox, because if you're investing outside of the top 54 markets in the country, then Dr. Muller's reports don't do you any good. And to rely on Dr. Muller's reports, I think, are a mistake anyway, because they are too far back into the past. All right, so we'll take a look at how to plot our market on the market cycle chart using the fundamentals. We'll look at rent demand analysis. And if you've been watching my videos on YouTube, you will see that I do a rent demand analysis on every single one of those videos. And then we will plot a market, in this case, the Orlando metro statistical area in Florida. Can you guys please mute if you don't mind? Or I can mute you, one of the two. And I'm not afraid to mute people. All right, so once we plot where we are on the market cycle chart, we need to look at what employment growth means. So the reason we're going to do that is, yeah, we have rental demand fundamentals, and there are a lot of markets that are declining, but how fast can they rebound? We know that by looking at the economic situation in those markets. And so we'll do that by looking at employment growth. And you'll see when I show you the real estate demand model, how important employment growth is, and not just any employment growth, but a specific level of employment growth that we'll get into. Then once again, we'll talk about action steps to move you through step number 2 of this 9-step acquisition method, and then have a Q&A session at the end. And then we'll go to lunch after that. So in our 9-step process, we are in step number 2, market selection. So right now, it's a little frigid outside. Okay. It's actually a little warm right now in Mobile. But what I mean by frigid is there's a lot of uncertainty going on in the multifamily space right now. We got banks that are failing, interest rates going up. Will interest rates continue to go up? Will they stabilize? There's a lot of uncertainty happening. So I kind of look at where we are right now in the market as kind of our winter storm. And so I thought this image was really appropriate for kind of where we're sitting right now and where sentiment is in the multifamily space. So let's talk about, should I invest locally or should I look at remote markets? So let's talk about local first. So one of the most important parts or things of investing in your local market is that you've already got local relationships. You probably have broker relationships. You probably have attorney relationships, CPA relationships, appraisers, title companies. If you've been investing in single family or maybe bought your own home, different things like that. Maybe not. Maybe you just moved to the local area and you don't have any of these relationships yet, but they are the easiest to build in your local area because you can be face-to-face with them. All right. Now, Zoom has opened it up for us remotely where we can be face-to-face on camera, but it's still not the same as taking somebody to lunch or happy hour or dinner or meeting at a networking event or something like that. So those local relationships are huge. You live in the market. So you know the lay of the land, you know where things are, you know where the bad neighborhoods are, you know where the path of progress is probably occurring. You can see where investment is happening. You can see where road construction is. One of the easiest ways to identify path of progress is road construction. The other is utilities. If utilities are getting laid outside the city limits, you know that the city is probably getting ready to annex that area, or there's been a lot of investment going in that direction. So you can see this because you live there. This is a huge benefit of owning in your local market. Now, a downside, it may not be an attractive market. It may be rent controlled like Portland. So if you live in Portland, although the Class A market is one of the best in the country, it's still rent controlled. The Class A rents in Portland, beautiful, beautiful city. Got Mount Hood in the backdrop to the east. You've got the Pacific Ocean to the west. You've got the Russian River running through and separating Oregon from Washington. You have all this beauty in Oregon, yet your market rents in Oregon for Class A are only around $1,800. Your Bs are more than that in Dallas. And there's nothing pretty about Dallas. Sorry, Sean. There just isn't. Dallas is very flat, very industrial. Nothing pretty about it. And it's hot there. Okay. You got beautiful weather in Oregon. Now it gets wet during the winter, of course. But it's a gorgeous place to live. But maybe it's not an attractive market to invest in, okay, because of that rent control. So that could be a downside, but that doesn't mean you can't find opportunities there, right? And if you're investing in your local market, it's the least amount of stress because you've got access to the properties you're investing in, especially if you're a passive investor. If you're a passive investor, you can go visit those properties and make sure those sponsors are doing what they're supposed to do, right? So there's less stress. So what about remote markets? Well, now you have to rely on remote relationships. You have to build those relationships within those markets. So as we go through this and you identify what market or what markets you want to invest in, you've got to start building relationships. That takes time, effort, energy. There may be travel time and cost associated with it. All right. If you're talking to an owner and that owner wants to meet you face to face before they give you any information, you might have to get on a plane and go fly somewhere. All right. There's some cost to that, obviously. Good news is you can pick good markets. If I live in Portland, but I look at Northwest Arkansas, and for those that saw Northwest Arkansas last week, Northwest Arkansas was still the best market we've identified yet. And here's this little tiny tertiary market that is outperforming everywhere. And, maybe I want to invest in a market like that. Now, I wouldn't recommend it right now because What goes up must come down, and it still has a long way to go before it comes down. We'll talk about that when we get to identifying what we should look at, but maybe that's a place I want to invest. And so I have the opportunity to pick where I want to invest, where I want to build my relationships, okay, rather than just working in my local market. So it gives us more potential opportunities, okay? So that's local versus remote, pros and cons of both. So let's talk about market cycle fundamentals. This is one of my favorite subjects. Market cycle fundamentals and economic based analysis are two of my favorite things. I just love them both. So let's talk about market cycle fundamentals. For the purpose of what we're doing in this intensive, we are in a down market. 90% of the markets we've looked at, and I think I've looked at 50 markets so far. I think that's the number, somewhere close to 50. 90% of them are heading down. They are on the slide, on their way down, okay? So we want to find a market that is either in or heading into the recession phase. And you may be asking yourself, why in the freaking world would I want to do that? Because if it's not heading that direction already, it means it will be fairly soon, okay? There are cracks in all the markets. We see what's going on in the economy. It is only a matter of time before they start to go down. What goes up must come down. There is no way you can skip a cycle. Every part of the market cycle, every phase, you can't skip a phase. It goes through the whole bell curve, okay? So don't think we can skip and go from oversupply back to, now if you're at point 13, you can back up, back across equilibrium and jump back and forth, but you're not going to go from oversupply to recovery. You cannot skip the recession phase. We can go backwards 1 or 2 points, but we can't go back to the beginning section of the expansion phase if we're 3 levels into the oversupply phase. It just doesn't work that way. It follows the bell curve, okay? You cannot skip a phase. So we want to be either heading in or in the recession phase because we're looking for the markets that are going to rebound quicker. So we can look at Dr. Muller's cycle reports if you're looking in the top 54 markets in the country. You can also look at my YouTube channel. I'm looking at all markets. I'm not just looking at the top 54. I think like I said, I think I'm right around 50 videos right now, just in the last 2 months. Well, I started first week of the year. So wherever we're at, right, I think we're at week 9 or week 10 of doing this. So you can look at those videos and look back through my channel and say, okay, well, there's Northwest Arkansas. I've been thinking about that market. Let me watch and see what he says about this. All right. The other thing is, if you are a strategic partnering member and you have not watched module 4, which is 3 lessons in the strategic partnering workshop, walk into this. It's one of the most important modules of the entire course. Okay. I teach the market cycle fundamentals in that part of the course, but more importantly, I teach economic based analysis, right? So these are resources that you can go back and look at to identify how to identify where I'm at a certain level of the phase. But we're going to take it a step further than that. And basically what we're looking for here is we're looking for markets with strong economic fundamentals that'll be able to bounce back the quickest. Look at Dallas. Dallas has had 2 straight quarters of negative rent growth in the entire MSA. Okay, we're not narrowing down to a specific trade area or neighborhood. I'm talking about the whole MSA as a whole. And if you tell me, well, Collin County is doing better than that, I'm actually going to tell you you're lying, because Collin County is actually worse than the entire Dallas MSA, because I did it. I looked at it. So if you're looking at a market and you can see that you've had negative absorption, which means more people are moving, you got more units going vacant than are being rented, that's negative absorption, and rents are declining 2 straight quarters, you're trending downward. Now, your long-term occupancy average may still be, and you guys will see examples of this in a minute, just kind of go with me a little bit. If your vacancy is still fairly low, it still kind of puts you up in that oversupply part of the phase, but you're heading down. But I like Dallas. And I like Dallas because of its economic strength. If you look at Dallas, Sean, how many people move to Dallas every single day?
Depends on who you talk to, but between 400 and 1,000.
Okay, well, it's about 100. You got about 100 people moving to Dallas every single day. Okay?
Yeah, maybe that's the state, 400 to 1,000.
Yeah, possibly, but they're moving to Dallas. It's about 100, sometimes less, sometimes more, but about 100 a day are moving to Dallas. So how in the world do we have negative rent growth, negative rental demand, 2 straight quarters in Dallas when population is exploding there? It's
Because people are doubling up in apartments and houses.
That's right. It's affordability. So there are still 38,000 units under construction in the Dallas market. Well, if we're already going backwards and we have no rental demand and we're building more units, it puts you deeper into oversupply, into the recession phase. How long is it going to take this market to respond back? Well, the answer to that is not long. And the reason is because of the economic strength of the market. Now, with the financial collapse starting to happen, and with layoffs occurring left and right, and as we get deeper into a recession, there are other factors that can affect this. But as it sits today, Dallas has very strong economic strength, even though they have very weak rental demand, which tells me they can respond back very quickly. And that's where we want to invest, because we want to ride this wave down to the bottom, really just before the bottom. And when I show you the market cycle chart in a minute, this will make sense for those that haven't seen it. When you are at that point right before the bottom, that is the best time to invest. And investing in a market that you know will respond back quickly will build wealth very quickly. All right. Does that make sense to everybody? That's why we want to look at markets that are entering or are already in the recession phase and that have good economic strength. All right. I've lost everybody at this point, but that's okay. Bear with me. I'll show you the numbers in a minute. So in the market cycle, there are 4 phases. Dr. Muller describes these 4 phases, and CCIM has adopted these 4 phases for their market cycle chart. There is a guru in the marketplace that claims to have created his own market cycle chart, David Lindahl. And he calls these buyer phase 1, buyer phase 2, seller phase 1, seller phase 2, or something like that. He's taken Dr. Muller's report and he's tried to make it his own, and he's really just calling it something different. And unfortunately, he has no idea what the fundamentals really are to even plot where it is on the market cycle. But he makes money from doing it, so I'm not here to tell him one way or the other. So phase 1 is our recovery phase. All right. This is where we were in 2008, 2009. We were coming out of recession, going from 9 to 10. We started in recovery. All right. The recovery is coming out of the backside. So this is the start. Phase 1 is your bottom left-hand part of your chart. Phase 2 is expansion. So now we've gone up above the long-term occupancy average, and now we're growing. And I'll explain how all this works here in a minute when we look at the market cycle chart. So phase 2 is our expansion phase. This is where we spent probably 10 years in this last cycle in the expansion phase. There are some people that believe we're still in the expansion phase. They are living a dream. Then we have phase 3. This is our oversupply or hypersupply phase, depending on what you're looking at. Dr. Muller calls it hypersupply. I just call it oversupply. And this is where most markets are today, is in the oversupply phase. Now, with each one of these, there's also definitions and solutions that we're going to cover here in just a minute. So this may not make a whole lot of sense, but when we start talking about the definitions and solutions, it will definitely make sense. And then finally, phase 4 is your recession phase. So here's what it looks like on the market cycle chart. So I'm going to get my little laser pointer here. So right here, this was coming out of 2009, 2010. We started at the very bottom, coming out of the recession and coming into recovery. So from about 2010 to about 2013, early 2014, we started to enter and cross this long-term occupancy average. I know it says vacancy average, but let's just call it the long-term occupancy average, right? So if we look back over the last 20 plus years, the average occupancy of that market, that's our long-term occupancy average. That's our horizontal line. This chart is a rental demand chart. Doesn't have anything to do with employment, any other economic factors. It is rental demand, and it is driven off the long-term occupancy average. That is our baseline that we look at. That's our benchmark when we do this. So this is a rental demand cycle. So when we look at this, as we cross this long-term occupancy average, where down here in the bottom, we have probably still some negative rent growth, but our occupancy is starting to tick up. Okay, here, this vertical line, this is our net operating income. As occupancy ticks up, we're filling units. We may not have any rent growth yet, but we're starting to fill units. As we fill units, that's more rental income. So with expenses being equal, that NOI starts to rise. Once we get above that long-term occupancy average and our NOI continues to rise, we get to a point in the expansion phase where now we do have rent growth. So now our rent, either quarter over quarter or year over year, is expanding, it's growing, and we start to accelerate a little faster where the demand can no longer, or the supply can no longer keep up with the demand. That puts us in the expansion phase. When we get to this point right here, notice it says new development. That means that our net operating income is now strong enough that developers can afford to build new units. So now development kicks into gear. And as we start to continue up and accelerate even quicker, we get into what's known as equilibrium. This is when demand and supply are equal. So when rents, which is our demand, when the rents equal supply, so it's not growing, it's not contracting, absorption is keeping up with deliveries, all that being equal, we sit right here at equilibrium. Up until this point, rent was increasing exorbitantly and absorption was way outpacing deliveries, meaning demand was stronger than supply. As we cross over, now it's very hard to call your equilibrium point. I do believe I put Northwest Arkansas at equilibrium as it sits today. So it is at the top of the market. Okay, but it can go nowhere but down. Now there's a good chance it could possibly come back if interest rates go down. Then Northwest Arkansas may come back to this point. Unlikely. I don't think interest rates are going to come down even in our headwinds that we're in. I think they're going to continue to grow. So we are going to continue down this path. But as we cross the NOI line, get past equilibrium, now rents are we still have rent growth. We're still above the long-term occupancy average, but now we're starting to see concessions, which just means that we're not getting asking rent. We're looking at effective rent because we have concessions. Absorption is slowing. Absorption is no longer keeping up with deliveries. So deliveries are outpacing absorption and occupancy is declining. And that's what starts to put us down the slide. Okay. Once we get to the long-term occupancy average, now we're looking for, do we have negative rent growth? Now for Dr. Muller, when he does his, he looks at year over year. So if you still have year over year rent growth, even though you're either at or below the long-term occupancy line, he'll keep you up here in oversupply. He will not drop you into recession until you go year over year negative rent growth. I will look at it on a quarter over quarter basis, and I will drop it down into here if we have 2 straight quarters of declining rents. And we've had that in the majority of the markets. But you've got to be below this long-term occupancy average line in order to get down here. For most of them, they're either right here on the long-term occupancy average or slightly above it. That's where looking at that 20 plus year line makes a lot of sense. And you're going to see an example of it in a minute. All right. So as we drop below it, now rents are definitely declining, either quarter over quarter or year over year. There are Many more units still left to deliver. Absorption is either flat, declining, or negative. And so we're starting this downslide to the bottom. This point right here is the best point to start investing, because if you buy right, you're not buying on pro forma, you're buying on true underwriting fundamentals. You can sustain this last little bit and then ride the wave up. These people that buy here are your wealthiest people for the next market cycle because they bought at the right time. All right. You guys understand that? Any questions on the bell curve for the market cycle chart? Okay. So let me.
Great information.
David.
Thank you so much, David.
Okay.
Yeah, I do have a question.
Go ahead, Ken.
So the long-term occupancy average, where is that's different for every market, and where is that
Different for
number
every
come
market.
from?
That's correct. It's different for every market, and you're going to need a supply side tool, and I'll get into that in order to get it. For me, I use CoStar, but there's CoStar, there's Reese, which is now Moody's Analytics. There's Axiometrics, and there's Yardi Matrix. These are all tools that a lot of people use. You are not going to get this information from a free source. So you either have to build a relationship with somebody that has access to it, or you need to pony up and get it yourself. Okay.
Got it.
The supply side data that we are going to look at, you cannot get from free resources. And I truly believe that this is why the gurus doesn't teach this information to you guys, because they already charge you so much money. They don't need you spending any more. They want you to spend more with them. All right. Don't give me the money, use the money in the tools. And it's also why my strategic partnering members, it's why I provide these reports for them, because some of these tools are unaffordable for most people.
But some of that supply side information you can't get directly from the municipalities, right?
No.
No?
No, they're not tracking this information.
Some of them are. Some do a better job than others. Like Nashville does a horrible job, but a place like Houston, I think, does a much better job.
What kind of supply side information are you getting from the Houston government?
Pipeline data.
Yeah, okay. Pipeline data you can get from all of your government. Yes, absolutely.
Mm-hmm.
But we were talking about the long term.
Every time we access, it deletes all the.
Hold on.
Okay, right. But you're talking more broader than that.
Pipeline HUD actually produces pipeline data on a monthly basis. And you can go to your planning commission to find out what units are under construction and what units are being planned. So yeah, absolutely. Mm-hmm. That I agree with you. But the rest of this, your rents, they don't track the rents. They don't track absorption. They only track pipeline data. That's it.
Right.
Okay. All right. Yep.
Okay.
We're on the same.
Thank you.
George, it was this spot right here, the one spot before the bottom in the recession phase, to answer your question. He asked, where was the best time to buy?
Hey, David.
Yeah, Victor.
Quick question. This is Sudhir. What is pipeline data?
Pipeline is future units to be delivered to the market. So it's anything currently under construction, or anything planned. Either one. So if a company or a developer has pulled permits, it is listed as in the pipeline. If they have not pulled any or it's listed as under construction. If they have not pulled permits, but they have submitted site plans for approval, that's considered planned. If they're just thinking about it and they've bought the land, but they haven't submitted any documents to the city yet, then it is not counted in the pipeline.
Okay.
Pipeline is future units, not existing.
And you said the county provides that or the municipality?
Yeah. Well, wherever you get the data from, either the municipality or the county, it depends on where you are.
Thanks.
Your planning commission.
Yeah, planning is usually the best source for that.
That's correct.
But it varies per.
It does. It varies per market.
Sir, I have a question.
Yes, sir.
as we sit right now with the recession coming, or I'm not sure if we're already in the recession, like they're talking about, so the thing you were explaining about investing, where the wealthy people start investing.
Mhm.
As we sit to this year, is it 2023? Is it 2024? Or is it already too late? Was it 2022?
We're not there yet. I believe it'll be 2024.
Thank you.
You're going to see a bloodbath in 2024 unless interest rates come down. If the financial market spooks the Fed and the Fed lowers interest, I don't think they're going to. We'll know Tuesday. Pay attention on Tuesday. When the Fed announces what they're going to do
Yes, sir.
on Tuesday, that is going to give us an indication whether they're spooked by financial cracks or not. That's going to be a telltale sign. I may change my forecast based on what the Fed does. But as it sits right now, if interest rates continue on the path they're going, 2024 is going to be the worst year in multifamily history for foreclosures, meaning more than you've ever seen in your life.
So meaning the best time to invest in multifamily?
Correct.
Okay, gotcha. Thank you.
You're welcome.
So, David, you said earlier that you cannot skip any phases in the bell curve.
Correct.
However, you could go back, a couple steps. So,
Correct.
if the Fed decides to cut rates, would you be skipping? Would you be skipping, or would you just be going back to maybe expansion?
I don't think we'll ever get back to expansion.
So if they do cut the rates, where would you be back to?
But it depends on the market. It depends on the market, Jason. You can only go back a couple of spots. And there's going to be other fundamental factors that are going to cause it to continue to go down the other way. But it will definitely slow the process if they cut the rates. And it will allow some of these folks that are currently in trouble, or at least see they're in trouble, it'll allow them to get out of their opportunities if they do cut rates. And we won't have such a big bloodbath in 2024 like I think we'll have. If the questions are regarding continuing with the current economic headwinds, can we save it to the end? If they're about the market cycle chart, I'd be glad to take them. Otherwise, we'll be here all day talking about economics. Ace, do you have a question? I think that's how you pronounce your name. I'm not sure. AYSE. You have your hand raised. Victor, you're unmuted. Did you have something?
Yeah, just a quick comment here. And this graph that you have up, that doesn't really take into account of time, right? Because you have here is pretty much symmetrical.
Correct.
Split.
Correct. Yeah,
so
and you're gonna see a chart that has a little bit better of a representation as to what it really looks like.
Gotcha.
So go ahead.
Can you explain on the chart what the green new development circle is again? I missed that.
That is when your net operating income, this vertical line, it's when your net operating income is high enough where developers that are seeing demand exceed supply can start building. They can now get a profit.
Gotcha.
Prior to this, there's not enough profit in the marketplace to build new units, even though at this point down here, demand is exceeding supply. But they can't start building until the NOIs in the market, the rents are high enough that they can start building.
Gotcha. Thank
Barbara
you.
says, you're welcome. Barbara says, my question is, some investors are saying they are not buying anything now because the phase of the market cycle. I was wondering your thoughts on that. Is there a place on the chart you don't buy? So it's based on risk. Everything we do is based on risk, Barbara. So if you are in oversupply or recession, you're in a down part of the cycle. Can you buy in the down part of the cycle? You can, as long as it is a cash flowing asset and that you're using good underwriting fundamentals and not buy on spec or pro forma like they've been doing the last 5 years. You will fail if you do that in this part of the cycle, but you can buy in this cycle. Will you make as much money as you'll make in recovery or expansion? No, because you've already crossed the top and it's going to go down before it comes back up again. Will you eventually make enough or more money? It depends on where you bought in the oversupply or recession phase. But the best time to buy is from this point right here, the point before the very bottom of the recession, to the point just one spot above in recovery. If you can buy inside these 4 points, or really 3 points, because this one and this one are the same. If you can buy in these 3 points, you are going to do very well. Anywhere else in the market, you're buying either above where it was at the bottom, which is what we see a lot, or you're buying too high before you get to the bottom. Does that make sense? And again, every investor is different. It's based on their risk. Vicky, people that get the replay paid for VIP. If you're just here on general admission, you don't get a replay. Rookies survive in expansion. Rookies get eaten in oversupply. Sean, you are dead spot on. All right. So let me lower that hand and let's keep moving before we're here all day talking economics. So here's Dr. Muller's third quarter 2022. He has not released fourth quarter yet, but if you play a little URL games, you can see his at least first draft of the fourth quarter, which we actually looked at yesterday in our weekly Q&A call. But you can tell from the way the lines were drawn that it is not his final draft yet, which is why it's not published. But again, it's only the top 54 markets.
I posted the link to the Q4 one in the chat, and you're right. It's not complete yet.
No, it's not complete yet. So that's why I didn't want to show it. So you can see in Q3, which I can tell you in most of these markets that the break occurred, or where the rents started to trend down, was between the second quarter and the third quarter. So we started in the third quarter to start to see the rent declines occur going into the fourth quarter. And a lot of those markets I've done. Now, Portland, for whatever reason, he has sitting here at equilibrium, and it may be because of the strength of the Class A. But when I plotted it yesterday, and he's got Portland sitting here at the fourth quarter also. But again, it's not a complete chart yet. I'm putting Portland right here at 0.14 based on the fact that it is sitting on the long-term occupancy average, even though the rents are kind of stable. But again, it's a rent-controlled market. All right, so you got to kind of play that into consideration. It's the first rent-controlled market I've looked at. So there's some fundamentals there that you have to pay attention to. Could you argue that it could be up here at 12 or 13? You probably could make that argument, and I wouldn't argue with you back. All right. So it just depends on where these fundamentals sit. But notice how more gradual his bell curve is on phase 1 and phase 2, and how more aggressive it is on phase 3 and phase 4. This is a better representation in time of how a market cycle really reacts than the just standard bell curve that I showed you that I drew. Usually we stay in expansion for a long period of time. Prior to our last expansion phase, you would hear people say between 10 and 12 years. Well, this last one has gone, what, 15 years? 12, 13, 14, 15. So all rules of thumb are out the window. I hate rule of thumb anyway. Every market's going to be different. You have a national market cycle, and then every market has its own. So you can kind of see where Dr. Muller has all this representation. And again, Sean put in the link the fourth quarter draft. I wouldn't pull anything from that yet.
Hey, David, quick question.
Yes. Go ahead.
So how do you know you're near the bottom? I mean, is it kind of like timing the stock market? How do you know you're getting towards the bottom?
Well, save that question for after we analyze Orlando.
Okay, perfect. Thank you.
Yep. All right, let's keep moving if we can.
Sorry,
here.
David, I have a question.
Go ahead.
There are like one number in the names of the cities.
So what these mean is if it's +1, here it's sitting at 0.12, that means last quarter he had it at 0.11. If we can find a -1, we can't. I don't see one. Anybody see a -1? I do not see a -1. So there are no -1s. If there was a -1, that means that it was at 0.13 last quarter, and it's at 0.12 this quarter. So, and I've never seen I've seen a +3. I've never seen a -3 on any of his charts.
Okay, thank you.
But that's just moving it point to point. So +1 means forward 1, -1 means back 1.
Got it. Thank you.
All right, so this is just a fun representation. I like to do this every time I teach 102. This is the stock market and what the emotions are at a particular part in the cycle. And in the stock market, it's no different than our bell curve we have. The stock market also has a bell curve. So if we look at this coming out of 08, 09, everybody was in disbelief. They had this thing that they were just like, this is never going to come back. We dropped, what did it drop? I think all the way down to like 6,000 or 6,500 on the Dow Jones, and everybody lost all their retirement. So you've got this huge disbelief going on. And so as it started to recover, it started coming back up and people started to get hope. Oh, a recovery is possible. They're not investing yet. Okay. Now, Warren Buffett invested all the way back here, but these guys have not started investing yet, your typical investor. So hope sets in, and then the market, it's got a lot of its volatility and it goes up and down, and then it has this real big jump, and then optimism kicks in. Oh man, this rally may actually be real. And it isn't until they get all the way up here to belief where, all right, now it's time to start investing. So they're buying way up here, way in the expansion phase of the market. So we can call this recovery down here. We can call this expansion right here. And we can call this up here in euphoria our equilibrium. So as it continues to go up, we're on a thrill ride. Think back 2 years ago and all the deals that we continue to see on Facebook. They're in this thrill ride of all these deals that are getting done. We went from a 5-year syndication flip model to a 2-year syndication flip model to an 18-month syndication flip model. We've basically become flippers in the syndication world, if you will. And so we're riding this thrill ride all the way up to equilibrium, and now we have euphoria. I'm a genius. We're all going to be rich. And you've got this euphoric feeling inside that this is never going to stop. How many times have you guys heard in the last 3 or 4 years, this is a new normal? How many people have heard that? This is a new normal.
A bunch.
Right? What goes up must come down. It's laws of physics. And it doesn't matter what it is. So now we get these correction points. So it starts to come down. You get these 20% corrections. And then it's complacency. It's like, we just needed to cool off a little bit, get ready for that next rally as it starts to get really volatile and come back up again. And then it starts to really go down, kind of like what we're seeing at the moment. And anxiety sets in. Oh my God, why am I getting margin calls? This dip is taking longer than expected. They think they're still in this correction. And then it drops all the way down and denial sets in. It's like, oh my God, my investments are with great companies, but they'll come back. Okay, kind of fills back into this euphoria and complacency. We're in denial. They'll come back. And then boom, we have that large drop. Black Monday happens. Bam. Now panic sets in. It's like, oh crap, everyone's selling. I need to get out now. You remember where we bought? We bought up here in belief. We're selling down here in panic. Can you make money that way? Anyone? Can you make money like that?
Nope.
No. Okay. Now, let me back this up. Okay. Everybody has been buying in the last 2 years right here. All the deals that we've seen in 2021, 18% of all multifamily properties sold in 2021, almost 100,000 properties, somewhere around 90,000 traded in 2021, all of them buying right here. Where are they trying to sell? Down here. How many people are trying to sell deals right now but can't because of interest rates or because they're coming up on their 3 years of their short-term debt and now they're going, oh crap, what are we going to do? Okay. Where are they sitting? See how this correlates? Okay, they're down here. They're panicking right now. Oh my God.
Yeah, they're
I
somewhere
don't have
between
long-term
denial
debt on
and
this thing.
panic.
Yeah, we're right here. Okay. Then capitulation sets in. You're like, oh, I'm getting 100% out of the market. I can't afford to lose anymore. This is just not going to work for me anymore. And then it starts to go to anger because now we're down at the bottom. We're in that part of the recession phase, that bottom point. Here really is where we should be buying. We should be buying at capitulation, not selling. And now it's just kind of trucking along and you start to get angry. You're like, oh, who shorted the market? Why did the government allow this to happen? Kind of what you're hearing right now. You know, why is the government allowing this to happen? Interest rates, right? And it just kind of trucks along and then depression sets in and your wife leaves you and your dog dies and you wreck your truck, for all the rednecks out here that know what I'm talking about. And then it starts to go up and then it turns into disbelief and we're right back into that sucker rally again. Okay. So this is not much different than our real estate market, but this is a fun representation that I like to show every time I do this presentation on market cycles, right? Pretty believable though, and is kind of what we're seeing in the marketplace. All right, so what are the definitions of each of these phases? First, we have what's known as the transition phase. This is now phase one, recovery. So we're coming out of the Great Recession and we're going into recovery. Right? So this is a period of reinvention. This is where companies start to create a new business model because the business model they had before didn't work, or at least they think it didn't work. And so now they're starting to revigorate a new business model. They start to diversify their risk because as you'll see, as you get into the recession phase or crisis phase, that's where they are getting rid of those non-core assets. So now we're back to diversifying risk again, and we get renewed customer focus. So we're starting to look for better residents. Prior to this, it was just how many people could we put in the apartment to at least get some rent. And now we're looking at renewed customer focus. Here, cash is king because there's very little liquidity in the market. And we start focusing on fundamentals. We're not buying on pro forma. We're not buying on spec. We're focused on fundamentals. And consolidation is continuing to accelerate because of foreclosures that are currently in the market. And that's really what we're going after. So what is our solution during this part of the phase? Now, keep in mind, this is for any asset class. This is for apartments, retail, industrial, office, hospitality, self-storage, doesn't matter. All levels of real estate is the same. Okay. So what's our solution in the transition phase? Well, now we start to build our pipeline back up. So we start calling on those owners. Now we should have never stopped, but we've got to get that pipeline built back up as to where are we going to find opportunities? We start to rebrand ourselves. Part of that, getting that new business model, we got to rebrand. We start to accelerate value add acquisitions because foreclosures are in abundance at this point in the market. And if we're going to be developing, if we're developers, we're initiating development. We're not developing yet because we're down in the recovery phase of the market. Rents aren't high enough where we can build, but we can start looking for land opportunities, start looking where investment is starting to happen and see where that path of progress is and start to plan where we're going to build when demand exceeds supply. We expand our offerings and we reposition, same as rebrand, we're repositioning, okay? These are the solutions when you're in the recovery phase. Then we get into the growth phase, phase two, expansion. This is a period of opportunity, rising occupancy levels, rising rents, growth in NOI, increase in asset value. All these happen when we get above that long-term occupancy average. Okay, then we get into development activity because now our NOI is high enough that the developers can afford to build. We have available capital in the market and we start to see new competitors hitting the marketplace. Who on this call has been in the multifamily real estate space prior to 2016?
Me.
Okay. When did we start to see the student syndicators hit the market?
probably around 10 or 11 really hard.
No, way after that. Way after that. It was about 2016, 2017 is when
Yeah,
they
I was thinking
Oh yeah, that's when they
2017.
really piled on. That's
when they
true.
really piled on, when that competition really heated up because they were given the belief that they could do this. And they've been saved by the market because of the fundamentals they were taught. They weren't taught fundamentals, they were taught spec. So those are the new competitors we're talking about, just trying to correlate it. Okay, we're in the expansion phase. So what's our solution here? Well, now we can start to expand vertically. So if I'm just investing in conventional apartments, maybe I can expand to self-storage, or not self-storage. Maybe I can expand to student housing, or maybe get into development, or maybe property management. But I'm still in multifamily. I'm expanding vertically. It's still my niche, but I'm staying within that niche. I'm just expanding the offerings that I have available to me in that niche. Expand geographically. If I'm in Dallas, maybe now I want to invest in Birmingham or Atlanta or Charlotte or Orlando. I expand my customer base. So now I am maybe investing in self-storage or mobile home parks or something like that, but still staying within that residential type investment. Even though self-storage technically is industrial, it's underwritten very close to multifamily, and residence in multifamily is your demand for self-storage. Really, any residence in any kind of residential property. We're investing in infrastructure. We're expanding adjacencies. Who knows what that means? Somebody impress me. What does expand adjacencies mean?
This is a total guess, but I'm thinking you're looking at things that feed into your real estate. Like if you're doing development, you'd be looking at like some of your suppliers, like your lumber and your sheetrock and that kind of stuff, or some of the equipment suppliers. But I have no idea.
How about buying up the lots around you?
Oh, well, there you go.
That's an adjacency. An adjacency is the properties that are touching your property. That's an adjacency. And we leverage capital. Capital is in abundance at this point. We are raising capital to meet the needs of the demand. Okay. That's the growth phase or expansion. We are no longer in this phase. For most markets, we are sitting here in the plateau phase or oversupply. Now, you guys tell me as I go through this, if you recognize that we are in the plateau phase. So this is a period of decision. We have a supply-demand imbalance. We have more supply than we have demand. We have optimistic underwriting. When is the last time anybody saw any kind of conservative underwriting? And Sean, you can't say your own.
I don't have to say my own. You told me I did conservative underwriting.
Okay. Optimistic underwriting. Pro forma, spec, unrealistic asset values. I went to a guru's little thing that he did virtually about 2 years ago. And the first thing he said to his people is, it's okay to overpay for the property. The market will come to you. Unrealistic asset values. Oh,
yeah, that's
laughed.
crazy.
Yeah, it's your best friend. Generous TIs. This is another way of saying, remember, this is for any asset class, industrial, retail, office. TIs means tenant improvements. Okay, that's another way of saying renovations. So generous renovations. Even Class B properties that have already been renovated, we're still seeing capital infusion of $2 to $3 million that don't need to be done because they think they can continue to raise rents. That's generous TIs. Rent concessions. There is not a single market I've looked at, all of them, all 50 of them, over since January, the first week of January when I started my video series. Not one did it have asking rent and effective rent the same. They are all sitting with rent concessions. And of course, we have high investment activity, as we've seen during this phase. Okay. So that's where we are right now. We're in a period of decision. So what's our solution? Definitely not what we're seeing. So you dispose of your non-core assets. If you diversified in the recovery phase into self-storage or mobile home parks or something like that, but your core asset is conventional multifamily apartments, then you dispose of those non-core assets and only focus on your core asset, because you're getting ready to have a period that you're only going to want to be able to focus on one specific thing so that you can make it through it. Now, look at this one. I got to highlight this. Look at what that says. In the last 12 months, how many people have bought with long-term debt? And I'm not talking about assumptions. Anyone? Anybody seen any property bought with long-term debt?
Very few.
Very few. Okay. But what's the solution here? Now, I didn't create this. This is from the CCIM Institute and the financial institutions that give you your MBA in real estate development. They created this, not me. This is a fundamental principle when you're in the oversupply phase. You lock in long-term debt, not short-term debt. Yet you still have people telling you short-term debt's the way to go. It's the way to go to foreclosure, but it's the way to go. Okay.
Hey,
so
David, does it matter whether it's fixed or floating on your long-term?
Yes, it really needs to be fixed.
Yeah,
because
that's my
especially in an
opinion.
environment where you know interest rates are rising, why would you go with variable? That's just doesn't make sense to me. Oh, but I can buy a rate cap. Now it costs you more money. Now you're stealing more money from your investors to get a deal done. Just go with.
Hi, David. Steve Smullen. I have a question for you.
Yes, sir.
Is there an environment when, in your opinion, when floating or adjustable rate would make sense?
It's risk adjusted, Steve. It depends on the risk and your goals. In the expansion phase and in a stable or declining interest rate environment, it absolutely makes sense. But in a market where the market is declining and interest rates are rising and you have to pay $1 million to get a rate lock, in what world does that make sense? You're going against fundamental principles. But people buy against fundamental principles all the time. Again, it's based on your risk, but it's my job to teach you the fundamentals. Then you have to make the decision on what you want to do based on your own education, your own experience, and your own risk. Remember, be students, don't be followers. Good question, Steve.
Thank you.
David, I have a quick question. This is Oma again. Two quick questions. One, how do you define long-term? Like, is there a specific number of years where it becomes long-term? And then two, say you did enter a property with an interest-only term, 3 to 5 years in that realm, and then you're now realizing that you're in the plateau phase, right? So now you want to convert it to a fixed long-term rate. What does that look like, and how does that impact? How does that communication look like with your investors?
Hopefully you're actually communicating with your investors. Most of them aren't right now. So if you got into a short-term situation because you're still in the expansion phase or think you're in the expansion phase because you really don't know how to identify the current cycle you're in because you're looking at Dr. Muller's charts that are 2 to 3 quarters old, then you assume you're in an expansion phase and you buy short-term debt and you lock in a rate cap, which again, locking in a rate cap means you should not have bought with variable. You should have bought with fixed. Fixed or variable, irrelevant. 3 years, you said 3 to 5 years. Well, that 5 means +1 +1. Well, guess what the +1 +1 means? The +1 +1 means optional. Optional by the lender, optional by you. You hit that 3-year point, both have an option on whether you can continue on for another year or not. What we're seeing today is they're coming up against that 3-year mark because of properties that were bought in 2020 and 2021. And the lenders are reaching out and saying, we are not going to exercise that option. We are going to call the loan due when the loan is due. And they are having to buy the difference between what it cost when they bought the property, say 3.25%, to what the lender can turn around and sell the property for, say 7%. They have to pay that difference or they can't go to their +1. Well, all you're doing is delaying the inevitable, and they're having capital calls to get that +1. Again, just delaying the inevitable and scaring the investor, saying, if you do not pony up the capital call, we're going to water down your investment. Well, here's my reaction to that. Who cares? You cannot water down my initial investment. So what if you water down my return? Because you're probably going to lose everything anyway in this case. So that's kind of where we sit in that raising interest rate environment. Now, when the owners identify this, their only choice is to either sell the property or refi it and refi into a long-term situation. Long-term just means permanent debt. There's always going to be a term attached to it unless you're with like a regional or local lender, which then you end up getting recourse, which just means you have to personally guarantee the loan in order to get a 30-year amortization with no term with a balloon. All of your non-recourse loans are going to come with some kind of balloon or a term cap, meaning 5 years, 7 years, 10 years, the loan's going to be due. Okay. And then if you go agency, you've got yield maintenance or prepayment penalties that can happen if you sell it too early. So you have all these things you have to look at. The problem now is they've bought on short-term debt. They paid 3.25. They bought interest rate caps, but it's just an interest rate cap. I don't know how many people have said, well, I get my +1 because I paid for an interest rate cap. No, that's not what that means. It just means that you're capped at that interest rate at that point. Doesn't mean you get the +1. So when the lender calls the loan due, what are you going to do? Well, all you can do is either sell or refi. But if you bought at 3.25 and today your interest rate 6.5 or 7, how in the world are you going to refi it when you paid pro forma and your NOI has been declining because the rents are going down in the market? Uh-oh, ruh-roh, Raggy, we're in trouble. Ruby-doo, right? That's why in 2024, I believe if interest rates continue on the route they're going, we will have a bloodbath. Does that answer your question, Oma?
Yes, it does. Yes, I would. So as a strategy, 7 years is a better window to look at than and up than the 3 to 5 is basically what I'm as an underlying statement that I'm hearing. Correct? Correct.
And here's my opinion on interest rates. I'm just going to give it to you, and I want to kind of end on interest rates and just keep going here. When the Fed finally stops raising rates and they've captured inflation and inflation actually starts coming down. See, it hasn't started coming down yet. They have you believing it has, but if you look at it month over month, it is still increasing. It is not coming down. Until they capture it and it's no longer coming down, it's actually declining, we're going to continue to see interest rate hikes. Once they stop the interest rate hikes, depending on where we are, if we're sitting double digit interest rates, they'll probably bring it down a little bit. But if we're sitting around where we are now, 6, 7, 8%, they're not going to touch interest rates. They're going to step back and they're going to let the market do what the market does. If you look at the last 50 years in our country, where have we seen interest rates excluding the last 12 years? If you take out the last 12 years, in the last 50, where have interest rates been? And exclude the late 70s, early 80s when it was up at 18, 20%. Exclude those two time frames. What is that long-term average for interest rates?
Around probably 6 to 8%.
6 to 8%. So why in the world is everybody assuming we're going to go back down to 3.25? In what world does that make sense? Okay, pay attention. There might be a quiz later. Look at the data. All right, that's all I'm going to say about that. So back to this, we got to build third-party work. That means if you're a broker, I'm on, let's see here. There we go. Build third-party work. That means if you're a broker, you need to look at maybe doing consulting or other things. If you're relying on transactions to make money, transactions are starting to get to a very slow to no transaction point. We're not at no transactions yet, but we have definitely slowed from 2021 to today. Okay. Definite slowdown, huge slowdown. So much so, a lot of the global brokerages are restructuring. It's time to accumulate cash. Okay. Doesn't mean you have to stash money in the bank or put it under your mattress. But if you're a syndicator, you need to start raising capital and not collecting the money. Just get soft commitments and just let them know where we are in the phase of the market and say, when we get to the bottom of phase 4, be ready to invest because we're going to pounce on all these foreclosures and you're going to have to be able to pay with cash because you're not going to get debt to buy those foreclosures. And downsize non-core, it's supposed to say downsize non-core markets. So if your core market is Dallas and you're investing in Charlotte, Orlando, and Atlanta, you're going to sell off your assets in those 3 markets and only focus on your core market. Okay, so those are the solutions for oversupply. That's our plateau phase, where most markets are today. But we're transitioning into the crisis phase. Some have already transitioned into the crisis phase, about 15% of the markets I've looked at. This is a period of change. Now we do have declining rents. We've got very little development, although we are still getting deliveries from development that has already started when we were in the oversupply phase. There's limited access to credit, and you guys are seeing it already. We had the 3 bank failures in the last 2 weeks. And if you look at the news and the articles that are coming out, lenders are already saying they are tightening up their lending standards based on what they saw from those 3 bank failures. Okay, so limited access to credit is already occurring. Doesn't say no access, it just says limited. You start deleveraging. Okay, if you are at 80% loan to value, oops, you're going to be in a little bit of trouble because your asset value is going to go down. We are now declining in asset values. We are already seeing this. Workouts and restructuring if you have long-term. If you don't have long-term debt, you're pretty much screwed unless you can get your investors talked into buying another +1 to give you through hopefully what will be the recession phase and coming out the bottom side. I don't think you can make it that long. I don't think even if you do get your +1, I think you're still in a lot of trouble. And then a lot of entities start to downsize, and we're seeing this already in the layoffs. Okay, so this is already occurring. So what is our solution? Here, acquire, acquire, acquire. When we get to the bottom of the crisis phase is where we make our money. Now we're acquiring those underperforming assets. We're acquiring necessity real estate, and we're acquiring market share, customer base, and talent. Now is when we're supposed to look at this as an opportunity, not as discouragement. Okay, this is opportunity for those of us that are prepared. Okay. No, Barbara, that's 15% of the 50 markets that I've looked at up to this point. Dominique, if you paid VIP, you will have access to these slides. Okay. Any questions on market cycles? I think we've answered most of them. That is probably.
David, I've got a quick question.
Go ahead, Brian.
Phase 3.
Yes.
I think most, speak for myself, at least, you feel like you should always be doing something. And phase 3 kind of seems like just hang out and wait, keep your powder dry kind of part of the cycle. What would you recommend the active investor do to, I guess, for lack of a better term, kind of keep busy while you're waiting for the stuff to shake out?
1, raise capital. That's 1. Get those soft commitments. Start getting investor capital ready to go. Don't collect any money, just get it ready to go. The other is if your risk can handle it, if you can stomach it, your investors can stomach it, you can still buy in the oversupply phase, but you have to buy with underwriting fundamentals, with long-term debt. The going in cap rate is higher than the interest rate on the loan that you can get. That is key, not the market cap, not some pro forma cap. Current NOI, today's NOI divided by the purchase price, that cap rate is higher than the interest rate on the loan. Okay, that's positive leverage. That means you will make higher returns than if you paid cash. If your cap rate is lower, that means you would have been better off paying cash for the property and not getting debt because you're going to make a lower return. That's negative leverage. Okay. That's one. If you can get a 75% loan to value on long-term debt, that means you properly underwrote the property. Okay. That means it's more than likely cash flowing day one because your debt service coverage ratio meets the lender minimum, which is why you got 75% LTV. Okay. So that's another indicator. And again, it's got to be long-term debt. So cash flowing, not value add, cash flowing day one. You're not buying on spec, you're buying for cash flow. Interest rate is lower than the going in cap rate, and it's long-term. And you can make it through the oversupply and recession phase if you buy correctly. I wouldn't be buying at 80 to 85% LTV. I'd try to get closer to 65, 70% LTV so that you have room to go down. And that debt service coverage ratio spread is a little bigger, because we all know that in the loan documents, if the debt service coverage ratio goes below the lender minimum, the lender can call the loan due. Will they? We don't know. They did in 08. Will they do it again? I don't know. Nobody knows. We won't know until we get there. But you do not want to risk your NOI going below your debt service coverage ratio. Does that make sense? Now, good luck finding sellers that are aligned with that fundamental philosophy, because you still have student syndicators that are purchasing with pro forma. And as long as we have that, the sellers are going to stay completely opposite of the majority of the buyers in the market. 2014 will change, or 2024 will change all that with the foreclosures if interest rates continue. Good question.
David, I'm so sorry. Just to kind of piggyback on what you were just mentioning there. When you're talking about purchasing at a specific number, does it make sense to raise more capital and put more down on some of these properties? What would the pluses and the minuses be in that same phase that you were just looking at?
Well, the minus is it's a lower return. The plus is you could probably get through the recession. That's
really it comes down to survival or not survival.
Correct. 100%.
Yeah, David, can I ask a question, please?
Sure.
Super, thank you. I was listening to a podcast yesterday, and what the gentleman said was the same thing you just said in regards to you buy based on the actuals right this moment. And then what he said was that, okay, now what you can do now is look at the value add component of the equation. Say as an example, if with the value add, you're going to make an extra $2 million, as an example. Then say, okay, what you do now is that you come between the actual, your offer price will be between the actuals and the pro forma.
Nope.
No, don't do that. Gotcha. Okay.
Disagree. You're still buying on pro forma. You're not all the way to full what you think it's going to be, but it's still a guess. It's still speculation. Unless you're buying on existing NOI, adjusted for insurance and taxes, but existing NOI, unless you're buying on that, you're buying on spec. And that goes against the fundamental principles of where we are in the market.
Gotcha. Thank you.
Yes, sir. Good question. All right.
David, can I ask one last question?
Yes, please.
So just going back to the conversation regarding those that took out bridge loans in 20 and 21, is it too early to pursue with some conversation around purchasing those properties if we know they're purchased with bridge financing?
The problem you're going to find, Mario, is that they're going to be overvalued and that you're not even going to be able to purchase it for the loan amount because your fundamental principles will not work. If you can find one that it does, yeah, it's back to the denial stage. That's exactly right. If you are lucky enough to find one that did work, chances are that they're probably selling it with a broker anyway and are already trying to get out of it, knowing that they can sell it and get out of this short-term debt. Trust me, the current owners that have short-term debt know they're in trouble. Make no mistake, they know they're in trouble. The problem is unless the lender is going to give them their +1+1, I don't think there's anything else we can do for them. Otherwise, you're just buying their headache.
Understood. I appreciate it.
Okay.
David, I got a quick question.
Okay.
And I'm not sure, I feel like you touched on it a little bit. I just want to get some more clarity. I actually just saw Dominique ask the same question. When it comes to adding a creative way to be able to purchase it, is that something that I'm assuming would be beneficial to create like a win-win structure as far as maybe like a deeper on the seller carryback portion
You're not
of
it? All you're doing is buying the seller's headache. You still have that long-term interest that has to get paid off, or the short-term debt that has to get paid off.
Right.
If that can't be paid off, you're just buying the inevitable. So alternative acquisition strategies typically don't work in this situation. Again, you're just going to have to wait for the banks to take these back and then be able to pounce on them when they re-enter the market as a foreclosure.
with the cash that we've been
With the cash,
working.
that's correct.
Unless it's 7 years or longer, you're saying?
Well, then they're probably going to make it through the recession if that's the case, as long as they bought it right. If they bought it on pro forma, there's still a chance that it'll go back to the bank because their NOIs are going to drop below their debt service coverage ratio. We just don't know how much restructuring the banks will do based on that data. It's not here yet, so we don't know. In 08, they took the properties back. I don't think they're going to do that again. I honestly believe in my heart they're not going to do that again. But it is in the loan documents that if it drops below, the NOI drops below the debt service coverage ratio, the lender can call the loan due. I just don't think they will.
Got it.
Yeah, well, especially if you're in that situation or you know somebody that's in that situation, if they reach out to the lender now versus when the time is up,
communication.
you usually start working something out because the bank doesn't want to be in the business of owning and operating property.
That's correct.
Right. Yeah.
Bridge lenders are different. Those are private investors, most of them. They are in the business of taking properties back.
Right.
Yeah, and they'll take it in a heartbeat.
In a heartbeat.
Somebody referred to that as the loan to own program.
Yeah, and they're not referring to you owning, they're referring to them owning.
Yes.
Right. So for them is Christmas coming early.
Exactly.
Got
it. 100%. All right. So
David,
yes.
Sorry, quick questions. Would you recommend, building relationships with banks and lenders during this phase?
I would recommend building relationships with mortgage brokers that can give you access to the lenders that are going to be the ones that'll be holding all this, all these assets. Again, the majority of your bridge lenders are private equity companies. They're not really true lenders.
Okay.
Okay, they're not banks, so to speak. There are some banks that did do short-term lending, and you probably can get a better chance of restructuring with them than you can private investors. But the majority of the bridge debt was from private equity companies that provided the debt. Okay. All right, let's keep going. Rent demand. No more questions. Save it for the end. We got to go. We're going to be here all day. All right. Rent demand analysis. Now, this is where we start to identify where we are on the market cycle chart. Okay, this is where the rubber meets the road. So we're looking at the rent analytics quarter over quarter. Again, I look at it quarter over quarter. Dr. Mueller looks at it year over year. He is an economist. He is a professor. He has an MBA. I do not. Take that for what it's worth. Okay, so it's just two different ways to look at something based on the same fundamental principle of the long-term occupancy average. He's just looking over at year over year. I'm looking at it quarter over quarter. Because if I'm investing in a deal, I want to know what it's doing quarter over quarter. A year is too long to wait for me. All right, so we're going to look at what I call the supply snapshot. That is a graphic representation of what's happening in the market. It's a infographic, if you will, and it's something that I can get in CoStar. Now, everything I'm going to talk about right here is information that I get from CoStar, but there are other tools do provide it. Yardi Matrix, Axiometrics, and used to be Reese, now Moody's Analytics. They all provide this same type of data. So in the supply snapshot, we can get total units. We can get how many units are currently under construction. We can get what the 12-month absorption is. When we get into the rent analytics, we can see it on a quarter-over-quarter basis. But for the supply snapshot, it gives us 12 months. Here's the definition of absorption. End of period, or in this case, in a 12-month period, end of year, and that means what's today, March 17th. End of year, March 17th, minus beginning of year, March 18th, 2022, whatever that result is, end of year, occupied units only, not total inventory, not what's vacant, not what's under construction, occupied units only. End of year, occupied units minus beginning of year occupied units equals total absorption, okay? It's a number, not a percentage. You can create a percentage rate in order to see how long it would take to absorb over a period of time. But when you're just looking at it as it sits today, it is just a number. It is not a percentage. So you can also do end of period minus beginning of period. So December 31st, 2022 minus September 30th, 2022 will give you what the fourth quarter, did I get that right? Yeah, October, November, December. We'll get the fourth quarter absorption for a market. And that's how CoStar represents it in the rent analytics. Are you guys good on absorption? Only occupied units. If we're increasing in absorption over deliveries, then that is the sign of a market in demand. If we're not keeping up with deliveries, but we still have some positive absorption, I like to say about 80%. 80% or more will give us a stable market. Anything below that, we're going to start to see the occupancy decline. So when the absorption is not keeping up with deliveries, but is still positive, we have a slowing absorption situation. And where the number is negative means we have negative demand. That means there's more supply than there are renters in the market during that period of time. That's what absorption tells us. Does that make sense? It's a way for us to determine demand. Okay. It is the key factor in demand. So we also look at the long-term, or we look at current vacancy in the market, and we look at the average current market rent, which will also be accompanied by annual rent growth. Again, year over year. Okay. So it'll give you the current market rent and it will give you the annual rent growth year over year. Then we look at the long-term occupancy average. This is everything the supply snapshot shows me. So now we get to have a little fun. Here is the Orlando Metro Statistical Area Supply Snapshot. I took this 2 days ago on CoStar. Okay. This is the entire Metro Statistical Area, conventional properties, meaning market rent properties. There are 1,492 properties in the market, totaling 213,157 units. Kind of sounds like my video, doesn't it? Okay. There are currently 23,895 units still under construction. Just let that soak in a minute. 23,895 units under construction in the Orlando Metro Statistical Area. Over the last 12 months, 3,533 more units rented than went vacant. So in 2022, 3,533 more units rented than went vacant. In 2021, 15,241 more units rented than went vacant, showing a major slowdown in absorption of 76.8%. Huge slowdown, which is why our vacancy has increased 2.5%, because absorption is not keeping up with deliveries. Now, we don't know what deliveries are yet, but we will see it in the rent analytic report. Okay. But right now it's telling us that we are increasing vacancy, decreasing occupancy in the market, and that absorption is not keeping up with demand. Yet we have a year-over-year rent growth of 3.7%. Okay. But that's on an annual basis. Now, what I've been doing is because we're looking at rental demand, this is known as, let me get my little highlighter. This area of the chart is known as your space market. Okay, these are the number of units in the market. This is our space. This is our capital market. These are people that are purchasing, that market cap rate and the sale price per unit. When we're analyzing demand, we do not look at the capital market. So we are ignoring this information. And I've been doing that in all my videos. We do not look at market cap rate or market sale price per unit. We are only looking at the space market. Now, if we look down here, we have the all-time average. CoStar goes all the way back to 2000. It gives us a 22-year average of what the occupancy is in the market. We can see that the long-term occupancy average is 92.5, and it's currently sitting at 92.25. Okay, that means that we could place the Orlando market, all other things being equal, on the long-term occupancy average. Now, is it on the long-term occupancy average between recovery and expansion, or is it on the long-term occupancy average between oversupply and recession? Well, the fact that we have units under construction tells us we've already gone through the expansion phase. The fact that we have increasing vacancy, decreasing occupancy, and that we have slowing absorption, yet we still have a little bit of rent growth, tells me that we are in between the oversupply phase and the recession phase. But we look at data to verify this information. Does everybody understand what I just did so far?
I have a quick question. Before we went to this slide, you mentioned, the total units under construction and the absorption. But when you got to absorption, you kind of, I defined what those indicators were. Would you mind stating that again? Like if absorption was down, et cetera?
So if this number was negative, that means there is no rental demand. This is our rental demand. Absorption tells us the demand for the market. Now, there may be jobs moving to, and people moving into the Orlando market. They're just not renting apartments. Or maybe they are, but they're roommating up, what we call doubling. That affects the overall demand. So if you did an economic base analysis, and the economic base analysis says that your future population should be an additional 20,000 people in the market, and if the owner-renter ratio was 40%, that means that you should have 8,000 people that are demanding apartments. But if they're doubling up, that drops that number to 4,000, maybe even less. And that's kind of what we're seeing in all these metro statistical areas. So absorption is our number one indicator for the demand for rental apartments. Does that make sense, Dominique?
Yes, thank you.
I have a question, David. So in regular language, it means that in Orlando, people are not, the demand for units renting is decreasing comparing to last year, 76%.
Correct. 100%. So in 2022, there was a 76% less demand for apartments than there was in 2021. That's exactly what that says. Good questions. All right.
So, David, I have a question for you. Orlando is kind of a peculiar place to be looking at this moment in time from a couple of perspectives. Orlando and Florida in general was a recipient of a great deal of what was called COVID migration. And then you've got the post-COVID reverse migration going on. And then add to that, you have an influencing factor. I'm going to make an assumption that some of the people that got whacked by a hurricane might have gone and temporarily rented inland a little bit. Orlando would have been a logical landing place. So how do you kind of read between the lines of these varying outlying influencing factors that you don't take into account in many other markets across the country? Is there a way?
We're actually going to be answering that question, Steve, as we move forward through this. But I happen to have analyzed the Fort Myers area that was hit by the hurricane. And you could actually see in the numbers, when I looked at it and analyzed it, that the people that were most affected by the hurricane, which were on the west side of that main road, where very few apartments were located, relocated to the other side of that road because the demand in apartments in that market shot up considerably in the third and fourth quarter of 2022 when that hurricane hit. It shows it right in the numbers. And
you know, I know a lot of people across the country, and I have to say, you're the only guy I know that would have looked at that.
Of course, the numbers
and
tell
I
us
meant that as a compliment.
I know you did. The numbers tell us a story.
Yeah.
Without a story, we just have assumptions. Yeah, we have data, but what does the data mean? We've got to interpret the data. That data tells us a story. So let's go into the data and see what kind of story we can pull from Orlando. It's fun stuff, guys. This stuff excites me. I'm telling you. All right. So let's look at now the analytics. That was the supply snapshot. Now we want to look at the analytics quarter over quarter. Okay. So we want to look at the effective rent, not asking rent. We can peek over and look at asking rent and see if asking rent and effective rent are the same. If they are, good chance this is probably going to be in the expansion phase. Now, from what we saw in the supply snapshot, I think we have very, very little chance of that happening here, but we'll see in just a second. Then we look at quarter over quarter occupancy. Is it decreasing? Is it increasing? Is it stable? That occupancy tells us where demand is heading, and it's completely controlled between deliveries and absorption. So occupancy will move up and down based on the amount of deliveries in the market versus the amount of absorption that is absorbing those deliveries. And then finally, we look at the units under construction. Based on what we see, how many more units are left. So if we're already slowing the negative absorption in the market and we still have 28,000 units under construction, that is not a good story. Okay, so let's look at the numbers. So here is the Dallas MSA polled 2 days ago. You can see, let me get my laser pointer so you can see what I'm doing here. All right, here are the total number of buildings in the market. That's properties, total number of units, what the average square foot is. Here's asking rent per unit. And I look at it per unit, not per square foot. So if we look at first quarter 2022, which is where I like to live in the fourth quarter right now. I tried, because CoStar came out and said, January numbers are out. We like January numbers. You can look at January numbers. But as we were going across the country, the numbers weren't making sense. The fundamental principles weren't there, so I am no longer looking at Q3 or Q1 2023 until we get into the second quarter. So I'm only looking at the fourth 2022 right now, first quarter through fourth quarter. So I look at where did it start? 1749 went up to 1820, and like with most markets, and I've seen this in 90% of the markets, between the second quarter and third quarter, which is when we still really started to get affected by interest rate hikes. And think about this, and this is something I haven't talked about in my videos. You guys get to hear this firsthand. Go back to 2021. There was a lot of excitement for renters coming out of 2021. The government gave them all this money during COVID. And now they had the opportunity to go rent an apartment that maybe they couldn't afford. And so they were upgrading to Bs and As and doing different things. Those renters, when they rented, now the ownership changes. And the ownership was told when they took over the property that they can raise rents $300. So your lease comes due. And let's say now it's 2022 and your lease comes due. And all those properties between fourth quarter 2021 and second quarter 2022, all those properties started trading hands. And now by second quarter 2022, fourth quarter 2020 through first and second quarter 2021, now by second quarter 2020, these leases are coming due. And now the new ownerships, because of all the trades that happened in 2021, they purchased the property that you're now in, that you got real excited about in first and second quarter. And now your lease comes due and the owner says, we're going to raise your rent $300 a month. If you don't like it, move. Do you think maybe that had something to do with our break between second and third quarter? I can guarantee it. Okay. I haven't talked about that a lot. But look at it, you hear it, story after story after story after story, how owners, as soon as their lease comes due, the owners are saying, look, we're raising your rent $300, $400, $500 or move. We don't care because we want to renovate that unit. How many times have we heard that? This shows us that's what happened. Because do interest rates affect renters? No, maybe the opposite. With interest rates going up, we should have more demand in renters, not less demand. But this is clearly showing we have less demand. So you have to look at the numbers and see what story it's telling. Answering your question, Steve? Nope, we lost Steve. Doesn't matter. Okay, do you guys agree with what I'm saying? Can you see
Yes.
in your mind? This is how we can tell a story with the numbers. All right, let's continue with this. So we can look at asking rent and effective rent. Now I was looking at asking rent, but really we want to be looking at effective rent. Notice we have a discrepancy. Asking rent $1,749, but effective rent is $1,743. That means the owner's asking $1,749, but they're not getting it. They have to give concessions, which means they're only getting $1,743. In the expansion phase, these numbers are the same. There probably aren't any concessions. But remember, we have a lot of deliveries hitting the marketplace. And because we have a lot of deliveries hitting the marketplace, the developers will give concessions to be able to lease these units up faster. That could have some effect on your effective rent as well. Again, we see it in the oversupply phase. We don't see it in the expansion phase. Another good indicator we're in oversupply, or at least in oversupply. Okay, so we had that break between second and third quarter where rents were declining, 2 straight quarters of declining rents. Okay, we can look at the vacancy. Well, not yet. It'll be on the next page. Okay, so now looking at our occupancy, we can see that occupancy was at 94.9 at the beginning. Now we're all the way down to 92.4. But let's look and see how this was affected by deliveries and absorption. So we can see that there are currently, well, I'd call it 24,596. I don't know if this number is accurate or not with CoStar, again, because I'm seeing erroneous data in the first quarter of 2023. But let's just say this is accurate. There are still almost 24,000 units left to be built and delivered to the marketplace. But let's look at what has been delivered. In first quarter, 1,516 brand new vacant units were delivered to the marketplace. Okay, how many absorbed? Well, look at that, a lot. Okay, great absorption number. More people rented than were delivered. That shows rental demand. Then 950 were delivered vacant to the market brand new. 869 absorbed. Now we got a slowing in absorption, but still we're 80% plus, and we still had a 0.1% tick down in occupancy, which is interesting. Normally we'll see it kind of stable, which means it was barely 94.9 going into, it wasn't a strong 94.9, it was a weak 94.9, which caused that break from this, 83% of deliveries. But good, again, good strong absorption. First and second quarter, agree with rent hikes. I'd have done it too. Then we deliver 3,406 units and only 223 absorb. Ruh-roh, Raggy, something happened. The market just broke, and it broke right in half. And we saw that because occupancy went all the way down to 93.4%. And if we go back, we decreased in rents. And that's exactly what the fundamentals between demand and supply are telling us. So that means that this market is reacting appropriately to demand supply fundamentals. Okay. Then we deliver another. So let's look at this. 3,406 units delivered vacant, only 223 absorbed, meaning we still have 3,200 units vacant. Then another 2,710 units go vacant. So now we're sitting around 6,000 vacant units and only 517 absorb. Okay. That's why we get this decrease in occupancy. All right. And that's why the rents are declining. So the numbers tell us, even if Orlando has good economic strength, and there are people moving to Orlando on a consistent basis, which there are, we know that Florida is the #1 state in the country in 2022 for in-migration. It was reported by U-Haul, it was reported by North American Movers, and the other big one, can't remember right off the top of my head. All of them reported that the #1 state in the country, which unseated Texas is #1, Florida was #1 in 2022 for in-migration. Yet we're showing no rental demand, or very, very, very little rental demand in this market. And it's because of affordability. Okay. The renters have finally said, we cannot rent at these prices anymore. We're going to roommate up, whether it be renting a 2-bedroom apartment with 2 or renting a 3-bedroom apartment with 3. That affects our demand. You guys see the story it's telling? How valuable is this?
Very valuable.
Yeah, it's good stuff.
Far more
It's
than
valuable.
$97 worth.
You think?
Far more.
Yeah, and 250 people on here didn't pay at all. They got it for free. So, all right, that's how we determine demand for rental apartments. I look at it, and it's why I look at it quarter over quarter, not year over year. Because if we look at it year over year, there was a 5.8% increase in rents year over year. If I'm an investor and I see 5.8 year over year, I'm happy. Woo, there's rent growth here. I'm putting in my pro forma 5% income growth. Look at it quarter over quarter. This is why I don't look at it year over year. Does that make sense? You guys are wondering why I go against what Dr. Muller does. That is why. Okay. There's a method to my madness. All right.
David, I have a quick question for you. Just trying to, as you're going so granular on the data, would that change your perception as a buyer on your unit mix that you might have had as an acceptable ratio? Should you slide that to accommodate what you're seeing in a situation like what you just presented, where people are buddying up and the rental, you're starting to see the occupancy go down?
No, because it's not going to last. People that roommate up, they're going to hate each other by the time the year that lease is up. Hopefully the market's been trending downward enough where the rents make sense again a year from now after they've leased it. And now they can break apart and go individual again. The market is always shifting. So right now where doubling is taking effect, it's a fad. It's not going to last. And we invest for long-term, not short-term, unless you're a short-term buyer. If you're a flipper, it's absolutely a strategy you can use in this market. Okay.
Thank you.
Good question. Yep. All right. That is how you determine rental demand. But what does that mean about plotting it on the market cycle chart? So plotting the market is all about seeing where the trends are heading in rents, deliveries, absorption, and remaining units under construction, and how that affects occupancy. Okay. Remember that long-term occupancy average is our baseline. Okay. So when we looked at Orlando and we looked at that supply side snapshot, our long-term occupancy average was at 92.5%, 92.58 to be specific. I don't have a good memory. I wrote it down. It's currently at 92.3. Okay. So it is under that long-term occupancy average, but one can argue it's on the long-term occupancy average. And I would argue that that would be appropriate. We still have 23,895 units under construction, Yet we saw a major slowdown in absorption, a lack of rental demand between third and fourth quarter. We had declining rents between third and fourth quarter and declining occupancy between third and fourth quarter. Knowing that information, where would you guys plot on this market cycle chart? Nobody want to play with me? Come on. Somebody's got to have it.
Oversupply.
Supply.
I
Okay.
would say
I'll jump in there. I see you in oversupply.
oversupply. Discussion.
I see you in oversupply there. You know, as you may recall from our prior conversations, I've spent a lot of years specializing, focusing on distressed assets. And the one thing I've observed for decades is that when we, in markets all across the country, overbuild, we don't just overbuild a little bit, we overbuild a lot. And when we overbuild by those huge numbers, it takes years and years to absorb those units and recover.
Okay. So which point, Steve, would you put it on in oversupply?
You know, sadly, I'd have it at the first tick into oversupply because we've historically grotesquely overbuilt. And the pipeline of in the works on your chart, if I saw it correctly, looks like that's exactly what we're doing. And at a moment in time when some people are exiting that marketplace.
Yeah, okay. That's interesting.
I mean, I would personally speculate that Orlando was more overbuilt than many other markets based on a momentary point in time. You know, lenders always want to get their money out there, and that drives development more than just about anything. Lenders making dumb loans.
Right. Agreed. So Sean says equilibrium. So I'd put it down here, right on this long-term occupancy average. This is where I'd put it. Because we still have 23,000 units left to be delivered. We're already in negative rent growth quarter over quarter, and we're already in slowing of absorption. Demand is not keeping up with deliveries. So I think by next quarter, and we'll see what it looks like when we get to the second quarter, what Orlando looks like. My guess is we're probably somewhere between here in the recession phase, because that occupancy is going to continue to go down. And when it dips down below that long-term occupancy average, it puts us down here in recession. And because that long-term occupancy average is sitting right on the line, I'm comfortable putting it right there. But
you know, another aspect of it, depending on how far along a project is, historically speaking, some of those projects are going to be abandoned. Suddenly those lenders are going to
That's correct.
shut off the flow, close the faucet.
That's correct.
And they're going to be empty shells standing there.
Yep.
Possibly for years.
100% agree. We're not speculating or talking about that right now, but that's absolutely what happens. So using Steve's analogy, I'd probably put it here. I don't think I'd agree that it'd be up here. I think at minimum it's here, but you can argue either one of these 2 points and probably be correct. Okay. So was that a fun exercise?
That was cool. And I follow you. You're smarter than I am on the analytics.
Well, I kind of
David, your ability to go in and dive in, and then I put it in the chat. Like nobody would use the logic of the math and the formulas to double check the software. They would just look at it and take it for what it is, and then keep moving. The fact that you are
that's what the brokers want you to do.
Yeah, amazing, man. Amazing. Thank you so much for this, man. This is a game changer.
I appreciate it, guys. Thank you. All right. So households drive housing demand, not population. Okay. Households drive housing demand. Okay. Whether it's an owner or whether they're a renter, households drive demand. That's the units. Units are the households. Units, the supply. Households occupy the units. Even if it's only one person. One person can be a household, but households are what drive demand, whether owned or whether rented. And population creates households. But what drives population?
Jobs.
Oh, look at there, right off the bat. Boom. Jobs. Okay. Real estate demand model. Stoney, you're going to like this one because I know you've seen this. Real estate demand model starts with jobs, but it's not any kind of job. This is where the gurus fail you again. All they tell you is you need job growth. Okay, that's not true. You need basic job growth. Basic is another word for export sector, and I'll get into the definitions in a minute. The real estate demand model, and it doesn't matter whether it's residential, industrial, retail, office, irrelevant. It all starts with jobs, but specifically export sector jobs or basic employment. Basic employment drives total employment. When you do an economic base analysis and you go into the marketplace and you determine how much export sector jobs are coming to the market, your market will deliver what's known as an economic base multiplier, meaning I have so many more, or I've got so much basic employment in the market. If I divide that total basic employment by the total employment in the market, it gives me a multiplier effect. It's kind of like the marginal propensity to consume. I know that's a big freaking term. Just think of it of how money flows in a market. It's like you throw a rock into a lake and you see these rings that kind of go out. All right. That's a multiplier effect. When basic jobs, export sector jobs come to a market, it creates a multiplier effect in total jobs. So when Mazda Toyota comes to Huntsville, Alabama, and they bring 4,000 jobs with them, we know Japan is paying those employees because those cars are sold globally. They're not sold just in Huntsville. And so that money is coming into the market. Then those employees are going into the market and they are spending that money. That's what determines whether it is basic employment or not. And because of that supplier, that manufacturer coming to the market, it creates other employment, like Steve, someone may want to build or lease a space that's real close to the Mazda Toyota plant and build and create a business for a bakery so that he can capture with donuts everybody going to work and capture with bread everybody going home when the wife calls him and says, hey, please bring a loaf of bread home with you. Okay, so they're capitalizing on that. But Steve is creating goods that are being bought locally in the local market, and his employees are then spending their paychecks locally in the local market. So now that circular flow of money is just happening inside the local market. That's the difference between basic employment and non-basic employment. We'll get more into it in a minute. But that's why basic employment will drive total employment, because of a multiplier effect. Total employment drives office demand. Total employment also drives total population. Total population, which creates households, also drives industrial demand and residential demand, and it drives disposable income because people spend money. And when people spend money, now we have demand for retail. Okay. This is the real estate demand model. But the point to it is that it starts with export sector employment. So when Neil Bawa tells you you need to make sure you have job growth in the market, ask him what kind of job growth and see if he can answer that question. If he does not give you the explanation I just gave you, get your money back. He's worthless. Now, I'm not saying that that's the answer you'd get. I'm tired of people not giving you guys all the information. And I think it's because they just don't know, honestly, even though he's the data scientist. Okay. Sorry, I get on my soapbox sometimes. So let's talk about employment growth. Okay. So support sector, that bakery, okay, non-basic employment. These service the local market. So that means goods and services that are sold in the local market. They are not sold outside the local economy. They're sold inside the local economy. And the money that is generated from those sales pay the employees and pay the owner, and then they go in and they spend money in the local market. But there's a problem with that, and I'll explain it in a minute. So this is not considered an economic driver. Look, we love Steve for hiring 6 employees to be able to operate as bakery. We just don't care. It does not provide any economic effect to our market whatsoever. Okay, so look at it like this. Look at a market. So the bucket is our market, and the water in the bucket is the money being circulated in the market. All right. So wealth is being mixed and churned in the market, but we don't have any way to fill this bucket up because the local people in the market are buying the goods and services, and the people that are providing the goods and services are spending the money in the local market. But what happens if somebody goes on vacation or buys a car in the next state or buys a boat 3 states away? Now we have what's called leakage. Okay. And so you'll see in my next slide how leakage is affected. So if we don't have export sector money coming into the market, meaning we're selling goods and services outside the local market, which is bringing money into the market, as money leaves the market, we need to have jobs that are filling that bucket back up. And if we lose those employers that fill this money up, that's how markets die. All right. So some examples of non-economic drivers are local restaurants, beauty shops and barbers, local real estate, insurance brokers, local Walmarts, Targets, and Lowe's. Okay. Even though the Target, the Walmart, and the Lowe's are national companies, the employees and the goods sold are sold to that local market. So they are considered non-basic or non-economic drivers. Was there a question? Okay. So let's look at what is an economic base, or what does give us economic opportunity. These are called basic jobs, otherwise known as export sector. This services, outside services, the local market. So services outside our market are our goods and services are sold outside the local market, but our employees are paid within the local market and spend their money in the local market. These are economic drivers, and all you got to do is look at how the money flows. All right. So we have an economic driver, Mazda, Toyota. Okay. Japan, cars are sold globally. Japan then takes that money and pays the employees that work at that plant in that local market. Those employees then go and spend that money in the market. But guess what? They may leave Huntsville and go to Dollywood and spend money outside the local market. They may go to Gulf Shores and go to the beach and spend money outside the local market. They may go buy a boat in Oklahoma. They might go buy a car in Georgia. Okay. So they are spending money in the local market and outside the local market. And if it wasn't for Mazda, Toyota filling the bucket back up, this market would be declining. This is how you determine, to use David Lindahl, the guru, the original guru, to use his terminology of emerging markets. This is how you determine an emerging market. Okay. Some examples are manufacturing companies, major headquarters, and a Walmart main distribution facility. Mobile was the benefit of a main distribution facility, 2.5 million square feet under roof. Talk about a freaking monster. That's 86 acres for those that are keeping track. Under roof. That distribution facility provides all of the goods for the entire southeastern region. Okay. That would be considered basic employment because Walmart is selling those goods. Well, they're housing those goods to be sold outside the local market, and those employees are being paid from those goods being sold outside the local market. Follow the money. Those are economic drivers, right? Does that make sense to everybody between basic and non-basic and how that correlates to economic growth?
Yes.
Yes. But I do have a question.
Go ahead.
So in the case of the Walmart center, not a distribution, but so like the manager of that Walmart, even though he's being paid and, you know, his job is non-basic, he wouldn't be considered a demand for, you know, a Class B, Class A apartment in that market?
Well, now that's targeting your psychographic and your demographic for your apartment. We're not talking about rental demand now. We're only talking about economic drivers.
Okay.
What drives an economy? That's what we're talking about now. Okay. Good question, though. All right. So where do you find basic employment announcements? Okay. Well, economic development. Every market has an economic development department. It may be a county, it may be a metro statistical area, it might be a state, but you can find an economic development department in just about everywhere across the country. There are some areas that are more friendly than others that will actually give you information. But the number one thing you should do is call your economic development department and ask them. Don't ask them basic jobs because they're not going to know what you're talking about. Remember, these people are hired as appointees, usually by the local government or by the governor. So they may or may not know economics. All they know is that they got to bring jobs into the state, or depending on the political environment, maybe the opposite, who knows? So I would not ask them how many basic jobs are coming to the market. I would just say in the next 3 years, how many jobs are coming to the market? How many companies is that? And if you can tell me, because sometimes the companies will not allow their name to be given, if you can ask for what company it is, then you get some bonus information. But if the announcement hasn't already occurred, then typically they won't tell you who the company is because it's considered confidential. But if you can ask them what industry they're in, now we can go look up the NAICS sector and we can see whether that's an export sector company or not. Or maybe ask them what goods and services they're going to sell. Again, they may be bound by confidentiality and not tell you that. But there's ways to identify whether it's export sector or not if you can get that NAICS code. If they'll give you the NAICS code, now all you got to do is go to Google and Google what is NAICS code, you know, blasey, 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 and it'll tell you what types of goods and services are sold by that NAICS sector. Okay. So economic development's number one. Chamber of Commerce, they love giving out employment information. They are number two. Your local business journal or your regional business journal. So in Alabama, there ain't but one. It's the Birmingham Business Journal. Even though our state is over 600 miles long, 450 miles long, even though our state's 450 miles long, the Birmingham Business Journal covers the entire state of Alabama, which drives me nuts because they only talk about Birmingham. Google. Anybody here ever use alerts.google.com? I do all the time. I have alerts set for the keyword multifamily, employment growth, employment announcement, job announcement, layoffs, and relocation. And then, of course, as we all should, I have an alert for David Monroe and David Monroe CCIM because we want to know if there's news about us online. Okay. So if you're not using alerts.google.com, you need to use that tool. I love it. Been getting it for years. CRE brokers, commercial real estate brokers. Ask them. They love to talk, especially now that there's no transactions happening. How many people tried reaching out to brokers for 2 or 3 years and couldn't get a broker to talk to you? Now, all of a sudden, they're calling you. Anyone want to comment on that?
I'm a broker and I ran into that problems as a broker. Nobody will call me back.
Yeah, because everybody's afraid right now. Fear in the marketplace. Okay. So that's where we find it. So knowing how many export sector or basic jobs are coming to a market can help you determine if the market can quickly bounce back after the multifamily sector goes through the recession phase. Let's look at Dallas. Okay. A lot of people love Dallas. There are still developers looking for land to build in Dallas. And I just scratch my head going, look at the numbers, you morons. The numbers do not make sense. But There are people moving to Dallas every day. There are companies moving to Dallas every month. It has huge economic viability. Now, with all the economic growth occurring right now and staying the same, not taking into consideration what may happen in a deep recession globally, nationally, or economically, let's just say that doesn't happen and they get this miracle soft landing they're asking for, then Dallas will rebound really fast because it has economic strength. There are companies moving. There are export sector companies moving to Dallas. Austin, same way. Houston, same way. Charlotte, same way. Nashville, same way. All these larger markets, Phoenix has to go through a very deep recession because Phoenix has really high highs and really low lows. So I don't think I consider Phoenix, but places like Boise, Idaho, Dallas, Houston, Nashville, Charlotte, Raleigh, Durham, these are all really, really strong, economically strong markets that can bounce back really fast. And which is why we're looking for markets that have the potential to rebound, but are entering either right on that long-term occupancy average, just getting ready to go in recession, or already in recession for conventional multifamily properties, if that's what you are targeting. Now, if you're targeting low income or senior housing or student housing, something like that, mobile home parks, it's a different, well, it's the same analysis. You just got to do the analysis same exact way we did this analysis, just for those specific sectors. Now there's a bunch of stuff going on in chat. Let me jump through some of this here. Oh, answering questions. Okay, no, looking, got the keyword category. Madeline, my keywords I use are multifamily, employment growth, employment announcement, job announcement, layoffs, and job relocations. And then of course my name. Barbara, pretty much all the major markets in the Southeast. Employment growth. Yep. Good. All right, good. Okay. So let's look at the market identification worksheet, because I built a worksheet for this. So as you can see, it starts with how many owners are in the market. Okay. Get that from that supply snapshot, or how many owners are in the market would be, you would have to go into the market and pull all the owner information. Now there's a one on CoStar, you can get what's called the true owner report. And you can get all the owners and how many properties that they own in the marketplace. So that'll tell you how many there are in the market. And the reason I ask that is because you need to be able to prospect 450 to 750 owners in order to be able to gain any kind of traction, or what the experts call velocity. So you have to have the ability to do follow-up. That's why I tell you only look for 1 to 3 markets. And what you're looking for is 450 to 750 owners, not properties, owners, because a lot of owners will own multiple properties in these markets. Okay. So how many owners are in the market? And again, you can go to CoStar and pull a true owner report for that. How many properties are there in the market? On that supply snapshot, we can get the total for Class A, Class B, and Class C, especially depending on what your investment criteria is. If you're only going after B and C, don't worry about A. I'd still get the information, but you're going to discount it. If you're just doing C's, get the information, but you're really only looking for C. Are rents increasing, declining, or stable quarter over quarter? We get that through that supply side rent analytic data. How many consecutive quarters did they either decline, are stable, or grow? Is occupancy increasing, declining, or stable quarter over quarter? How many consecutive quarters? Is absorption increasing, declining, negative, or stable quarter over quarter? How many consecutive quarters? How many units are under construction? What phase of the market cycle would you place this market? And of course, I give you an example of the market cycle below it. Use economic base analysis for the following 2 questions. So if you don't know how to do economic-based analysis, reach out to me about being part of the strategic partnering community, and I can teach you how to do that. That would be an entire intensive all by itself. This will give you an idea how quickly the market can rebound. Is there export sector job growth in the market? Well, we already know how to find that. How many total future jobs? Well, in order to get total future jobs, you got to know what the economic-based multiplier is. Now, I can show you guys a very quick way to determine the economic-based multiplier, but it's going to be a little old. So I'm going to minimize this, and I'm just going to go here, and I'm going to open my case study resources page and click on, oh, that's right, they got rid of that link, but it's right here. So I will put this in the chat box. So you can put either your county or your metro statistical area. So first one to type it or tell me, what MSA or county do you want?
DuPage County, Illinois.
All right, so county. Did I spell page wrong?
D-U-P-A-G-E.
Oh, DuPage, D-U-P-A-G-E. DuPage County, Illinois. All right. See, the problem here is the data is going on 5 years old now, and markets change pretty consistently. But if I click on DuPage County, it'll tell me that the economic-based multiplier is 7.42. So what this means is that if there are 4,000 basic jobs or export sector jobs coming to the market, that means 28,000 plus total jobs are going to be created because of DuPage County. That's the number we're looking for on this report here. How many future total jobs? Is there population growth in the market? Yes or no? And then how many total future population? So once you know there's 28,000 new jobs coming, you can then go and ask the question in Google, how many total jobs in DuPage County? And it will tell you what the total jobs are for the market. Then you go to census and you ask census, what is the total population for the county? And then you divide total population by total jobs, and that gives you your population employment ratio. So if I have a population employment ratio of 2.5, and I have 28,000 future jobs coming to the market. Now I know this is way over everybody's head, but that's what this is all part of. So if I got 28,000 times 2.5, that tells me that I have a future population of 70,000. If I have a future population of 70,000, and now we can really, really start to drill down and say, well, how many households are in the market? And what is the people per household? Now I can divide total population by people per household, and I know how many households I now have demand for because of 70,000 people moving to the market. And then if I take my owner-renter ratio, let's say it's 40%, I can multiply that 0.4 times the total number of household demand. Now I got my rental demand for units in the market based on the population coming to the market. But all that changes if people are doubling up. It's irrelevant if people are doubling up. But what it does tell you is what it can be once the rents are back under control as the rent market continues to decline until it gets to an affordability that the market can handle, okay? So is this market somewhere other investors would invest in? So if Portland has the strongest Class A market in the country right now, are people investing in Portland? Not really. So it needs to be a market people will invest in. And then is this market a market I want to prospect in? Okay, that's how we use this worksheet. All right. I understand that economic-based multiplier and population employment ratio just went way over everybody's head. And 4 people even said as they left the building, whoo, this guy's way too much for me. And they left. That's okay. So market identification worksheet, that's what we just looked at. So action steps moving forward. So review the metro statistical area rental market updates on my YouTube channel. For those that just saw it, I will go back. If you have not seen it yet, I'm going to copy this and I will put it in the chat. I highly recommend you check out those videos because it's going to help you determine what market will be good for you. Review Dr. Muller's cycle report, platinum and strategic partnering community members only. I didn't tell you guys this when you signed up. Okay. You get to request up to 3 markets. What does that mean? What's that mean? That means I will give you the supply snapshot and the rent analytics for all asset classes combined, Class A, Class B, and Class C. And I will send you the MSA market report that is available in CoStar. Again, for only Platinum and SPC members. Okay. Determine basic job growth. So call economic development, call the Chamber of Commerce, do your alerts, things like that. Find out how much export sector job growth is coming to the market, plot the market on the market cycle chart, and identify the market that you want to invest in.